So what it is this course will be looking at various trading strategies. The aim is to provide effective strategies which can fit into the lifestyle of various individuals. We provide these strategies which, if properly used, can be combined to trade various market structures. The course will also include trading psychology, trading plans, and trade management. Is that clear?
Yeah.
Is this statement clear? Because you see, people have different work structures. And so we want to put strategies out there which can fit into anybody's work structure. Especially I realize that the 4-hour strategies are very flexible. And so if we leverage on that properly, we can take advantage and still make good, use of it whilst we're still doing our everyday thing. Now, so this is the content. We will be using what we call section 1 is the 4-2 strategy. We have to enhance the 4-2 strategies properly. So that there are times when you will go into the 4-2 strategy, because of the way the market is, you might not possibly make money from there, or you might not win a trade even 2%. And I've gone through it. Generally, you can make it 2%, but there are areas which you might not make it. So with that, we've enhanced this in a way that you can possibly make your 2%. You know what I mean? So that is what we're looking at. So this 4-2 strategy, in this section, we leverage the use of the moving average to effectively trade the 4-2 strategy and psychological levels. The aim of this is to eliminate false candlestick patterns, reversals, and trade the right opportunities. So I'll explain what that means. And then so the part A of it would be the 4-2 strategy revised with moving averages and psychological levels. And then part 2 is the 4-2 strategy trading plan. So any strategy that we are trading, one needs what we call a trading plan, which means a written down approach on what you need to see before you go into the trade. And so it's a tick box approach. You need to see this tick, that tick, that tick, that tick before you go into the trade. If you don't see those things, or if you don't tick those things, then possibly the trade might not go the way it is. And you can even still take it and the trade might not go that way. But you want to almost like do your basic work before you go into any trade. So we'll be writing a trading plan. Every individual needs their trading plan. And then trading psychology. The trading psychology talks about how you deal with your mindset. Because sometimes the trading plan is that when you even are going to trade, you should have been well rested. You should have been in the right frame of mind, because emotions comes to play a lot when you have trades open. You know what I mean? And then trade management. Whilst you have opened your trade, imagine you go into a trade and you realize that, oh, you've made a mistake. Don't sit and wait and pray that the trade will go into your direction if you've traded the opposite way. All you could do is just close your trade. You know what I mean? So like how to manage trades, or when you've gone into the trade, sometimes you see that the thing is about to hit your stop loss, but it's still not your take profit, but it's not hitting it. And it's closer to hitting it. Just close the trade in profit.
Yeah.
I'm not saying once it just starts and it's not going anywhere if I close the trade. No. But sometimes it's almost there. Close the trade. Just that. Take your money and then you find another opportunity. Some people too, they'll be like, oh, the trade, maybe they didn't put a take profit, but they have an idea where the take profits will go. And the trade keeps going and going and going and going and going. They don't want to put a take profit, or they keep moving their take profit. I mean, that is not good trade management. It is okay for you to leave some money on the table for the markets to take it, that kind of thing. So those are the things we'll be looking at. Section 2, which is the 1641 strategy, but this one, we are doing that on the 4-hour. So it is just like the 4-2 strategy, but it follows this same pattern. So in this section, we leverage on the use of the moving average again to effectively trade the 1641 with key levels. You see this one, we are looking at key levels. We'll still use psychological levels, The aim is to help those who intend to trade inter and intraday trading, which means people who want to hold trades for a longer time. So the 1641 strategy, the 2A is 1641 strategy on the 4-hour, and the 2B is 1641 trading plans, trading psychology and trade management. So now, what we are talking about here is, for example, this is 16. This is Ethereum, right? Let's look at some Lightroom. Let me close all the psychological levels. Where is this? 1, 2, close. Let's put on only the key levels. Yeah. So what we are looking to do is, you can see clearly that we're in the 4-hour, and in the 4-hour we have the key levels. So from all the way here, you come here, all the way there, you go there. But among that, you can see some certain support areas. This can either be psychological levels. Let's say we put in psychological levels. What we are trying to do is, because this one we're trading the 1641 on a bigger time frame, we might possibly eliminate some of the psychological levels and trade it on key levels. So when we talk about key levels, for example, you could see that, for example, here, this is a key level, this is a key level, this is a key level, this is a key level. But here, it did not hit a key level. Here, did not hit a key level. So instead of using a key level there, it might be a psychological level that is hitting. So we can put something like a support there, right? Just a support to hold the place. And then we trade using the various moving average signals. And we'll go there in a second. We'll start possibly the first one in a second. All right, so maybe we then start, when we get here and there's a support, we use a support line, the same support line this time. We had it, we'll push it there, and then we'll find the confluence. Once we get the confluence using the moving averages, we are in. You see, so you are into the next, this thing. Here, personally, this one is below the 100 moving average and stuff like that. So when we're doing the rule, we'll see how we can trade this. There's a way we trade these things. So once we see the condition, so we'll rather be using the support line. So once we've created the support line here, we put a support line here, we look for the condition. If the condition, we're going in, that kind of thing. So that is what I'm trying to explain on this other one. Yeah, on this one. Now, the third one, which is the 1641, the 1-hour strategy, that's a strategy we just did. However, there are some opportunities that we can use when we are trading down. Normally, we look at it crossing and we're trading all the way up. We'll revise it again and we'll find strategies. This is good. So I'm saying that section 3, the 1641 on the 1-hour. The 1641 on the 1-hour. In this section, we leverage on the use of the moving average to effectively trade a 1641 with psychological levels. The strategy is for those who would want frequent opportunities on the 1-hour time frame. So with this one, normally you will be using alerts. And then once you go in and you're using alerts, when they call you, you go and sit there. So you get many opportunities. But it also means that the disadvantage is that you need to sit by the computer or you get frequent alerts. And as you keep the alerts, you have to then go and see that, is that the right opportunity? That kind of thing. So that is actually what we have, but we're using the moving average and psychological level. That's what we've really recently done. Now, the fourth one, we call it price break structure, section 4. That's PDS. It's a 30 minutes and a 1-hour opportunity. But this one, you just trade it like twice a day. And then if you have the time and you can sit for those times, the opportunities normally present themselves between almost like 7:30 and 9:30 or 7:30 and 10:30. And then in the afternoon, about 1:30 to about 3:30, thereabout. So if you can trade those ones, we'll also learn those strategies. Once we also use, so it says in this section, we leverage on the use of the concept called price break structure or session momentum. Some people call it session momentum. This strategy is effective. It's effective when used with moving average to trade. This strategy can provide up to 2 scalp opportunities in a day when used with, or no, when used on the right pairs. This width shouldn't be on the right pairs. And then we will just come with a concept, the PDS strategy itself, 30 minutes or 1 hour, and then we look at the PDS trading plan, trading psychology, and then that kind of thing. You see, so that is what it is. So this is the structure. So we are going to follow each. I don't know how long it might take for us to finish each, whether it is maximum will be 2 weeks per each. Sometimes we can even finish one in a week. You know what I mean? Based on strategy, because I'm giving you all the strategies as much as I can. Then you can test it and choose one which is good for you. So today, what we can do is just jump straight into the course. We're going to be jumping straight into the course with this. Let's jump with this, the second session. And from the second session, as I take the second session, I'll be showing you how it ties in with the first session. So today, what we're going to be doing is the 1641 strategy on the 4 hour. So the 4-2 would also be shown whilst we do that. Do you understand? Very, very simple, very straightforward. Now, we know that with the 1641 strategy, we normally said we will draw our psychological levels on the our key levels on the 16 hour. So we go into the 16 hour and then we draw our key levels, right? Do you remember how to draw key levels? Do we know how to draw key levels, you know?
Yeah.
How do we draw key levels? Where is the Prempe? I cannot hear the Prempe guy's voice. Is he local or is he in Ghana?
Sure.
You
So
know him?
no, I thought you knew him.
No, I
Okay.
don't remember who Prempe is.
Okay, so the key level is the rectangle.
So why are they called key levels?
Because that's where like the price is either is bouncing between those key, like the price is bouncing between those key levels, basically.
Yeah. So key levels, they are strong, high, they are strong levels on higher time frames. They are support and resistances technically on higher time frames. You know what I mean? So normally some people will use their key levels on the monthly or on the weekly or on the daily, but we are using on the 16 hour. You can even go to the daily, and if you look at the daily very carefully, our key levels is almost like similar
Yeah.
on the daily. You know what I mean? It looks very, very similar. So there's some here we can actually move this, or we can say, okay, we want to move this down here now as a key level. Just say something, just when you go into the, let me close this one. When you go into the this thing, because this is just a revision that I'm trying to do
Yeah.
so that you know why we have the key levels. When we go into this thing, you can clearly see there's a resistance here, there's a resistant area, there's a resistant area. So if you put, let's say, a line there, let's make it yellow so it stands out. You put a line there, it is a key level. There's a resistant area there. When it comes, there's like a support here. When you just take it and put a line there, it's a key level because we are picking it on the daily or on the higher time frame. In this case, we're picking on the 16. That's why we call the strategy the 1641. So now this is like a key level. This area, so which means that once we've had a support here and a support here, we are expecting that this could also be a support, although it didn't hit it. So it's just an area that we are careful that when price comes to that level, let's say we are in a 4-hour time frame, and we see price coming to these levels, we know that it can bounce off it. Do you understand?
Yeah.
Price can return or reverse of it. If it breaks through that, then we know that price is going to form another low level. So let's say these are the key levels, right? So these key levels, when you're even sitting in the lower time frames, you could still see them. Now, with the concept of the 1641 on the 4-hour, it's very, very simple. Very, very simple is that we create our key levels, right? We still would use things like our psychological levels for taking profits, right? So we have our key levels here. We still use our psychological levels to take profits. So how does it work? The question is, you will need the moving averages. The moving averages, as we said, we need the EMA.
Yeah.
We need the SMX as well, right? So generally what I have done is I went in and I created a little bit of I twisted a little bit of the code in the SMX. So you might see my difference, but it's the same concept. So you need the 5, or let's say that this one is the 4. Let's put the 4 on it. You need the 4, you need the 10. But we change this to 5. So let's make it 5. This one, I moved the 10 there. So you can either make it 4 and then 8, where you see the 4 and 10. And then we needed the 20, we needed the 50, the 20, we needed the 100.
100 and then 200.
And then 200. Okay. That's fine. So, because we needed these, what it is what colors are they? We made the 5 the yellow. The 20, we made it the something like the off-white.
Right.
And then the 100 was the blue and the purple. This one. And then the 200, I'm going to bring up the 200. The 200 is the red and the green. That's what it is. In the 1-hour strategy, we were going to be using the 200 in the 1-hour strategy. In the 4-hour, we will use the 100. Okay. So when we are using the 100 in the 4-hour, we can turn off the 200 now. Okay. And then let's stick to the 100 in the 4-hour. So we have the 5, the 20, and the 100 for now. Okay. Now, I might introduce the 10 or the 8 version, but I want us to create the basic concept. So the basic concept is simple. We know that any time that price or the yellow line, which is this 5 moving average, it crosses the 100, it tells you that we are in the trend, in the direction to which it's crossed, which means we have the 100, the 5 is crossed below, which means we are in the downtrend. Do you understand? We have the 100 line, the 5 is crossed up, we are in an uptrend. Do you understand? We have the 100 line, the 5 is crossed below, we are in a downtrend. It crosses up, we are in an uptrend. It crosses below, we are in a downtrend. So that was the basic concept, meaning therefore that we set an alert on the 4-hour and says that, you know what, anytime the 5 moving averages crosses the 100 moving average, call us. And then we'll come and take advantage of trading in that direction. So for example, we trade in that direction when it crosses down all the way down to, you see, to a key level. That's the yellow line. It bounces up and it comes back to a key level area, breaks the key level, comes across up, bounces back on the key level. Do you understand? Now, all this way, we wouldn't trade up generally, according to the basic concept. All this way, we wouldn't trade up. We'll only wait for the price action, which is the yellow line, to cross the 100. And then we'll trace this one up to that key level, okay? I'm about to show the exception, right? I'm
Yeah.
about to show you the exception. That would make you trade up. Very soon I'm about to show that. But we are creating the basic concept. So now the basic concept says that when we've crossed up, we are trading up. All the way that it was coming here, we didn't have an opportunity to trade down because the basic concept says you only trade in the direction.
Okay.
Yet not. But I'll show where you can trade down. I'll show that in a second. Okay.
Okay.
Now, this one crosses up again. So now that it's crossed up from here, we are going up, up, up to the psychological, to a key level. Now it crosses down all the way. This opportunity, technically, we are missing out. And then we start trading when it comes down here. And then we go up again, we trade up, we get opportunity to trade up, we get opportunity, we trade up. It crosses those, we get opportunity to trade up, it bounces off, we trade up. So we trade up. When it starts crossing down here, we are waiting for it to cross the main 100 before we trade the opposite way. It crosses the 100 again, we are trading up. Then here, coming down, we are not trading anything according to the first principles. You know what I mean? But now, you can clearly see that if we say we're going to trade that way only, we might not make the best use or the maximum use of the the trades or the trades which we get, meaning that we'd only wait and trade in the direction. So, like for example, all of this place, all of this area.
Yeah.
Where's my square? Where's my square? All of this area, we will possibly not trade it. You understand? And wait for it to come here. But it's a huge opportunity to be able to trade that. So the second premises, the second principle is very simple. And that is we trading safe, right? And I'll show you guys a third principle as well. The second principle is we said this thing should cross for us to trade. So here we traded up. When you look very carefully, for me to create the second principle, I am going to take off the 100 and I'll show you something with the 20, only the 20. And then I'll put the 100 back on. When I put the 100 back on, you would understand it a little bit better. So let me take off the 100. Now we've only got the 20.
Okay.
All right. So now that we've got the 20, you cannot tell whether we were in a downtrend or in an uptrend. You cannot tell it. The 20 can give you an idea that imagine if we are using the 20, we can just say that whenever the yellow crosses the 20 up, we are likely to be in an uptrend. When it crosses down, we are likely to be in a downtrend. Okay, so now look at the 20 very carefully. And I'm going to put some lines on it. Now, this thing crosses the 20 here. Oh, sorry. Let me go back. It crosses the 20 here. Okay. It crosses the 20 again here. Oh, God. I'm putting on the wrong line. Hey. It crosses the 20 again here. Oh, no, here. It crosses the 20 again here. It crosses the 20 again here. All right. It crosses the 20 again here. All right.
Yeah.
Crosses the 20 again here. Now, meaning therefore that we see that whenever it crosses the 20, it retests and it goes in the direction. Right? It crosses the 20, but it retests under the 20. So it goes in the 20's direction. It crosses the 20, it retests. And when I say retest, let me explain what that means. You realize that when we cross the 20, anytime we cross the 20, we'll be coming into the direction and then we'll go back up to cool off. We come back down, we go back up to cool off. We come back down, and then we go back up to cool off. What I mean is, you see red candles, and then a green candle, the opposite way, to cool off. and then red candles, and then green candles the opposite way to cool off. You can see that even though we are going in a downtrend, we still print green candles. So this two and then a green will cool off. 1, 2, 3, 4, 1, 2, and then we'll cool off on the green, and then we'll continue, and then we'll cool off again. We'll continue, and that is what we call the retest. So it broke, and then it retest. It went down, it retest all the way here, and it came down in the direction. It retest on this one. It came down in the direction. Now, what I'm just trying to say is, whenever the yellow breaks the white, which means it's 5 breaking the 20, you realize that it retests. It will cool off. When it breaks it, it will bring the candle and then it will cool off. And then it will continue and it will cool off in there, continue cool off in there. So look at that same principle here. We were here, it broke it the opposite way, but it cooled off down, which means it did not cool off within the white, the opposite way. It cooled off outside it. That's why we continued down. Look at here very carefully. It broke it up. It cooled off in the direction, the opposite direction. You see, it broke it going up, and it cooled off, not breaking out of this thing, the 20 moving average. It broke. It retest in the 20 moving average, so it started continuing up. It retest within the 20 moving average, so it started continuing up. Here, it came and it broke it down, and it retest somewhere like on the 20 moving average. So it came out of it. It's broke it in again. When it broke it in, the retest was within the 20 moving average. This is the 20 moving average. It was within it, and it continues up. Do you understand?
Yeah.
Do you understand what I'm saying? So it continues up. Now it breaks it again. It retests within, going the opposite way. It breaks it, I'm going down. It retested within it, so we continue down, right? Retested, we continue all the way down. All the way down to this point. We broke it up again. We retested on this one, but it was within the 20 moving average.
Yeah.
So we started going in the same direction. It retest within, we are going up. It retest within, you see? But then it started going up, it stopped, and it retest outside. It retest outside of it, and it broke up again because we're going in a direction. Now, it broke down, it retest within, going down, and then we came down. Now, I'll show you something. I'm going to bring the 100 MA now. Now, this is 100 MA. Now, let's go back. This thing broke 100 MA here, right? We broke the 100 MA here. At the same time, we broke in the 20 MA. So we know that according to 100 MA, we have to go down only. Do you understand? According to Peirce principles, we are going down all the way. Now, we would have waited. Do you understand? We would have said we will wait for the candle and for this 5 MA to cross the 100 before we trade this one. But the second principle that we just talked about is it broke the 20 and it retested within the 20. So you can trade towards the 100. And it retest again. You broke it. You can trade towards the 100. So you can now trade the opposite way. So you can start trading the opposite way earlier from somewhere there, right? Before you get to the 100. Why? Because we know the break and the retest of the 20. When it breaks the 20 and it retests within the 20, we can get the direction.
Yeah.
Do you understand? So that is the principle. You can either even decide that I'm not going to even be trading with the 100, and you'll be trading with the 20 and the 5. Just that you need the 100 to give you a clear or a fair direction. Now, what happens with the 100 is that when the 100 is in your direction, you don't even need to wait for a so-called retest. When it breaks, you can be in the trade because the 100 is helping you to go in the direction. It is very clear when it is only when you need to trade opposite, because the 100 says you're going down, but you want to trade up. That is where you need this principle to say that we've broken through the 20 and retest within the 20. So the 20 plus the 5, they are now going to fight the 100. So we can go against the 100 now. So they can just move towards it. And then you can trade that trades, you know. Now, The other thing is that, look, we broke in here, right? So this one was, we were going above, yeah? We broke in down here. We retest within it. All the way going towards the 100. And then we traded down. It went through the 100 nicely. Now, as we went to the 100, we are under the 100, which means we're looking for downward opportunity. But you can clearly see that the 5 broke into the 20 again, and it retested in the 20. When it retested in the 20, you can go into the trade, and it takes you up, Clearly enough, the 100 was going up. So even if we say we want to do without the 100, we could still do without and trade the retest within the 20. Within the 20. It crosses, we trade the retest. It crosses, we trade the retest within the 20, so long as it is within the 20. The problem with that sometimes is you would see that this thing broke out of the 20. You see, it broke out of the 20 and then retested in. But the thing is, you could just trade this. Why? Because the 100 is telling you we are in the direction anyway. You wouldn't have to wait for a break into the 20 if the 100 is there to help you. And that is why we put on the 100. Do you understand? So when you have the 100, you could still trade the 100 in the direction of the 100 without having to wait for the 20. But if it is coming against the 100, like we're saying, we are going up according to 100. But look here, it says it's coming down. All you wait is you let the candlestick break and then retest. When it retests, gives you a pattern, you are in the trade towards the direction. You will retest again within it. So in this case, because we have the 100, even this retest, you can still trade it up. You know what I mean? And that is where the 4-2 strategy comes in. The 4-2 strategy, I'll show you how that works in a second. And then you would, because this one is retest within the 20, you can still trade it down. So meaning therefore that we have the 100 saying that we are going up. We have now the crossover into the 20s, meaning saying that we can still come down. So within here, if you get an opportunity to come down, come down. If you still get an opportunity to go up, you can go up. Why? Because the 100 is saying go up, which means that the market is swinging widely, up, down. You know what I mean? Here, it was below the 100, so we are only expecting trades to go down. And it's sideways for a long time, broke through the 100. Now we can go in the direction of the trade, 100 and the 20. So when you look at this very carefully, I don't want to keep going on and on. You will rewatch the videos. Once you rewatch the videos, you would understand clearly what I mean. Okay.
Yeah.
Now, the final thing I'm going to say is very simple. How can you trade the 4-2 strategy with this? Okay. So let's say we have a psychological level. I'll put some random psychological levels on it. So we have a psychological level here. Let me take the vertical line off. We have a psychological level here. We have, let's see, another one here. And I think with this, we have to clear out the psychological levels properly. But let's say we have a psychological level here. Look here very carefully. So you see this candle, these 3 candles. This one is not even clear. Okay. You see these ones, this one. We have sort of like a tweezer bottom here. Yeah. Can you see the tweezer bottom?
Yeah.
Yeah. So meaning that after this, you can trade this candle, can't you? This one. But the point is, you can see that this is a break. It is a retesting candle. This is a first retesting candle. This is a break. This is another retesting candle. How do you know? Because the line just broke the moving average here. It just broke here saying I'm going down. So I'm going down. This one is the cooling off candles. These 2. Do you understand? So if they are cooling off candles, normally cooling off candles, they don't stay for too long. So this one breaks. If you want to trade this candle, you know that because it's a cooling off candle, it will not stay for too long. So even if you are going into this candle, it should be a very short stay candle. And before then you come out. You know what I mean?
Yeah.
Yeah, so that is where I'm saying that you can be able to determine false trades because you rather would wait and trade this one, which has a longer distance. So you can, even if you want to make 2%, you can make it 2% here. When it gets here, because of the direction of the 20 MA, you know for sure that this one, it wouldn't stay for long because it's just a Richards candle. So you will wait and then trade this one. You know what I mean? Because those ones are going in the right direction. You come here, you see something like this, you might think is a morning star. So which means you want to trade this. No, but because you are under even the 100 and the 20 says I'm going down. So wait to get this evening star and then trade this one. That doesn't make sense.
Yeah.
Do you get it?
Yeah.
That does yeah, have you got questions?
I haven't got a question. You've explained it well. It's just it's like the 20 and the 100 when it's retracing
Yeah.
is not super clear. So imagine if you get confused and you just go in instead of just waiting.
Yeah. So where give me a place where you can see that confusion and I'll show you what to do.
Okay. When you had the vertical lines, it was easier. So
Okay, let's go.
for example, uh,
So these are vertical lines.
where it crossed, yeah. So just as the 5 crosses the 20,
Mm-hmm.
like where your cursor is now, it's
Mm-hmm.
not so clear that it's retracing. Let's just say the candles is not there.
Okay. Let's just say the candles are not there.
Yeah.
But how would you know it is retracing without seeing the candle patterns?
That's
So
you can't.
imagine let me this is the area, yeah?
Mm-hmm.
So let me mark it. Okay, and then let me take the moving average off. All right. So this is the area. There's just these this is the area. Let's take this off. So we're talking about here. Normally, yeah, imagine you are doing 4-2 strategy. If you see this, what would you think it is? The green and the red. What would you think it is?
A tweezer top.
You might think it's a tweezer top. So if it's a tweezer top, how would you trade? You trade down, isn't
Trade
it?
down, yeah.
You trade down. Fine. Let's put the moving average. That same way, you see this is a tweezer top. It's still a tweezer top. But why wouldn't you trade down?
Because the 5 MA has,
Because the 5 just crossed the 20, saying that we are going up. The 20 is below it, which means it's pushing the market up.
yeah.
Do you understand? So that is the reason why you would not trade this down. Because you can clearly see that, oh, the 20 is below them. The 20 is a dynamic and what we call support or a resistance.
Yeah.
Do you understand? So the 20 is below it. You cannot trade it down because this has become a support. Do you understand? So rather, because this is down, it is guiding you that the opportunities are not down here. They are up there.
Yeah.
Do you understand? So you can wait to even get this and then trade this. You know what I mean? And trade an opportunity. Don't ever trade down. You can get this and get that, but wait and trade on. Imagine you even go in here, right? And then the thing retraces all the way. It will still take you up
Yeah.
because you are in the direction. When you get this thing top and you want to trade this, you know the 20 is below you. Even if you take the risk, you can say, how far is 20? 20 is here. So you will just only take it something quick before it comes to the 20, and then you're out.
Yeah.
When you see this one, you see this one is on the 20 exactly. So the 20 is not behind it, it's on it. So which means sideways. Do you get what I'm saying?
Yeah.
You get this thing, you get something like an opportunity like that. If it's on the 20 or it shows its head above the 20, you can go in now.
Yeah.
Do you understand? So we have this and that. This one is like this thing, how we call it, a bearish engulfment, these two. But why wouldn't you go down? We have the 20 here. Because we have the 20 here, how far down can it come? You see, it came a little bit. If you look at the tip of this thing, it came a little bit, and then it couldn't go any further.
Yeah.
Do you understand?
Mm-hmm.
That came a little bit. It couldn't go any further. Why? Because the 20 is stopping it.
Yeah.
So rather, you will wait for these two candles when this candle finishes, and then you go into your 2% here.
Yeah.
And then so the direction of the moving average tells you clearly where the opportunity lies.
Mm-hmm.
Do you understand? So you can even get this, and it will retrace all the way. But let it finish its retracement. It still takes you up.
Mm-hmm.
So as much as possible, this tells you that, listen, I'm below here. I want everything, I'm pushing everything up.
Yeah.
You know what I mean? Until the yellow crosses. When the yellow crosses, what we are saying is that let's wait for something like a retest. So it crosses, it gives you downtrend again. If you are daring, you can only trade this one, but that comes with experience. And then it retraces, Then we got this. So we can go into that. Even if we're using 4-2 strategy.
Mm-hmm.
We are winning very well. Why? Because the 20 says, I'm now up, you cannot come up. It retraces twice, it gives you this opportunity. Go into the trade.
Mm-hmm.
They're coming down. You can get out 2%. You know what I mean? Now it gives you this sideways. It gives you this thing, doji, and
Yeah.
then it will possibly give you this one. And then you go into this one if you are even using the 2%. You know what I mean? Maybe you might not even get it. So let's say even this trade, we broke even. We didn't win anything.
Yeah.
Because we would have gone into the trade on this one. It came down here and it came up here and it was siding and possibly you got out before it was too late. Now you realize it's just running sideways. But all the opportunities we are looking for now that it's running sideways, you see how close that this thing is and you see how close this is, which means it's going to be a sideways market for some time. Even if, let's say, we are only trading in that direction only, we still got this. We can go into that. We are only looking for downward strength. This one say up. You're not even bothering. It hits here. You don't get any clear sign. Buy. It crosses, which means that the 5 crosses the 20 again. Now that the 5 crosses the 20, you have a clear this thing, tweezer, a bullish engulfment. These two. Then you go into the trade. Take your 2% here. There's a retracement there. There's another bullish engulfment. You go into this trades here. You take your 2% here. Do you understand? There's this tops here. It just retraces. Don't mind it. Why? Because the 20 says we are going there.
Okay.
Right? You wait for this. This is like a morning star. You go into the trade. It will bring you down, but then it takes you up. Do you understand how it is? So although it might look like you are losing a trade here, you're technically not losing because 20 is saying we are going up. If it breaks you down, it will still take you. Why? Because 20 is going up, 100 is even going up. Just let them take you all the way up. You get out 2%, you're out. You're out, you get a retest on here, you get this one, you can be in the trade again on this one. It takes you up, it brings you down, but it takes you up again.
Yeah.
So you see how we can use the MAs, the moving averages, to help us even trade the 4-2 better. Because with the 4-2, normally what would happen is that we see some top like that. We might get this trade. And then we see something like that. We might get this trade. But we see this, would you get this trade? You get it down. It's a trees at top. But you get it down. You lose the trade. You see, so what will help you eliminate this particular fake opportunity is that you look at the MAs and where they're telling you to go. And that is all I was saying. You know what I mean? You look at the MAs, it's telling you we are going up. So look out for the up opportunities. So like something like this, it wasn't even clear because this candle and that candle, this one is smaller than that. So possibly you might not even take it. It comes down. We're not looking to go up. This one, it's not even equal. You wait and wait. And then with this, one thing is you wait a lot to go into the right candles. But the thing is, you look at the charts every 4 hours. what you can do then is you increase the number of coins you're trading. You know what I mean? Once you increase the number of coins you're trading, you get opportunities everywhere.
Yeah.
Just sitting there everywhere. I realized that this coin, CHZ, I don't know whether it's called Chili's or something.
Yeah.
Chili's, yeah. It looks opposite to AVAX or one of the coins. Let me see. Was it CRV? CRV looked very opposite to AVAX at the time.
Mhm.
You know, so because it did, I had some trades on that. You know, I'm now going to tidy up my psychological levels. These are the coins I've picked up. Excuse me, to trade based on that. And then it also works for Forex. So, like for those who wants to do Forex, this thing works for Forex. You know, so that is really what it is. So, like for Forex, GDP, JPY. The Forex market is very choppy, but look,
Yeah.
you see it crosses. Can you see the screen?
Mm-hmm.
The yellow crosses it clearly, right?
Yeah.
We had a retest. Even if we say let this candle finish, we can still trade this one. You know, here it was clearly below this one, so we're looking for down opportunities. Whenever we get small down opportunities, we trade it. Up, up, it gives us this down. So we would have traded on this one. It came down a little bit. It went up and it brought us all the way down again. So up again. We would have possibly said we'll trade this one. And then we'll go in and take us up. And it brings us all the way down again. You know what I mean? So this one is up again. This one is sideways, sideways, sideways. All the way. So it crosses, the yellow crosses again here. And then possibly we can say we'll go in here. And it will take us wherever it will take us. So with the moving averages, it helps you have a clear direction that, oh, even though we might have 100, we still have a 20. And whenever the 5 breaks the 20 and retest within the 20, we can have an opportunity to go the opposite way, that kind of thing. So the simplest way that people can also say that, okay, I'm only trading the 20 and the 5, and then use the second principle to trade things. And you can do that. And it's very, very clear. You know what I mean? The thing is, with this 20, you must ensure that the retest happens within the 20. You
Yeah.
know, if it crosses the opposite way, the retest must happen within the 20 before you go down. So this becomes a retest, and then you go down. That kind of thing. Now, here, this portion, you cannot do anything. You have
Yeah.
to wait for the cross and then retest, and then you can go up.
Mhm.
Some people say, oh, we are losing this trade, but there's a way to trade this, and that is the concept we're looking at now. And
Okay.
that concept, you might possibly not even need many lines of moving averages. It's a different thing. I'm learning now. You know,
Mhm.
but with the moving averages, you can learn the strategy and get clear opportunity. You
Okay.
know, yeah.
Yeah. Okay, that's good.
Yeah. You know, so I think that is that.
Okay.
Any questions?
No, it's all pretty clear.
Yeah. All right. So I think
It's
so
still
far so good. So we'll just end this call for today, and then we go on the big on the this thing, beginner's course tomorrow. I'll continue teaching what I'm teaching.
still
So we'll
recording.
catch up very soon. Okay.
Yeah. All right, Michael. Thank
All
you.
right. Have a good night.